Hello world, my name is Alejandro Romo, and in this channel we talk about investing, personal finance, and all things money. There's a lot of different methods or strategies when it comes to investing, and today we're going to go over two different ones: lump sum investing and dollar cost averaging. So stay tuned.
I want you to deal with your problems by becoming rich.
So like I just said, in this video we're going to be going over lump sum investing and dollar cost averaging, and why I prefer dollar cost averaging over lump sum investing. I'm also going to show you guys a chart so you can see for yourself why I like to dollar cost average. So regardless of which strategy you decide to pick after watching this video, just remember that timing the market is better than timing the market. So let's get into it. So let's start off with lump sum investing. So with lump sum investing, it's pretty simple. You start off with a big amount of money and then you invest it all at once into a particular investment. Now, if you want to do dollar cost averaging is you start off with a large sum of money and you invest it into the market over a periodic time. That way your money averages out into the market. These periodic times can be whatever you want. It can be bi-weekly, every Monday, once a month, whatever works best for you. You know what works best for you, so do that. So now let's go over two examples, starting with lump sum investing. So for this example, going into the dollar cost averaging, we're going to be using at the beginning of the year investment. So with lump sum investing, let's say it's January and you want to invest $6,000. You have $6,000, and what you do is you want to invest that money with company ABC, for example. So what you would do at the beginning of the year in January, you're going to invest the whole $6,000 into company ABC. All right, so let's say company ABC is worth $50 a share. If company ABC is worth $50 a share and you throw your $6,000 investment to ABC, then you would get 120 shares. Why? Because 6,000 divided by 50 is 120. Pretty simple. Now let's go over our dollar cost averaging example. So going back to those $6,000, let's say it's January and you have those $6,000. You want to invest those $6,000 equally across the year from January to December. So what you would do is divide your $6,000 by 12, giving you a total of $500 available per month that you need to invest every single month. Again, remember that you can do this any way that you want. If you want to do it weekly, bi-weekly, even daily, it's possible. Whatever works best for you. Just do the amount of payments divided by the 6,000 to give you the amount of money that you need to invest for that recurring period. So as you're making your recurring investments, you're going to be able to see, depending what the market is doing. If the market is going up, you're going to be buying less shares. And if the market is going down, you're going to be buying more shares. So now let's go over a chart that I made so you can see what it would be like to dollar cost average within a year with $6,000. So the chart is going to be right here. You're going to see it go from January to December, and I'm going to break it down a little bit for you guys. So as you can see right here from the chart, this is my dollar cost averaging chart that I made. This column right here is for the months. This column right here is for the investment that you're making for that month. The third column is the price per share. This is how much the share cost you when you made that investment. And the fourth column is the amount of shares, how many shares you got with your investment for that month. So focusing right now on column 3, at the very bottom you can see the average cost per share is $53.33. The way you come up with this answer is by adding all these prices right here of how much they cost you, and if you add all that up, the number is $640. But then you have to divide it by 12 to give you your average. Your average will come out to $53.33 per share. So focusing on column number 4, amount of shares, the way we come up with these numbers is you divide your recurring amount by the price of the share, giving you a total of 10 shares, for example, in January. From there, you add all these numbers up and you get this result, 117.64 shares in your account now. So now that we have all this data right here, let's go over it a little bit further. So let's say if at the end of the year, company ABC is now worth $55 a share. If you decided to go the lump sum investing way, you would still have 120 shares at the end of the year. And if you multiply the 120 by the market value of the stock, your investment will now be worth $6,600. Now, if you decide to go the dollar cost average route, you would have approximately 117.64 shares. Now, when you multiply that number by the current market value of $55, your total investment should now be worth $6,470.20. So as you can see from my two examples, if you decide to do lump sum investing, it was actually better for you to do it this way because you ended up with more shares and your investment is worth more than it does if it was dollar cost averaged. So the difference between lump sum investing and dollar cost averaging would have been 2.36 shares and a total of $129.80. As you can see from those differences, it really isn't that much. But if we look further into the chart, you can see in April that the stock dropped all the way to $35. The person investing in the lump sum route would have seen their investment drop down by 30%. Their investment would only be worth about $4,200 at that time. That's $1,800 less than what they started with. I always like to say that money is a mental game. So if your plan is to hold long term and just keep holding and see what happens, then you would be fine. You would have no problem. But now, if you're the type of person that folds under pressure, you probably would have sold if you would have seen your investment drop that much. And the reason that you would sell would be just to avoid any further losses. If you really think about it, if you were the person that was investing the lump sum amount and in April of 2020, you decided to sell all your shares, not only are you selling for a loss, if you would have just held all your money all the way into December, you would have been in profit at $6,600. So you're missing out. You're losing money because you sold, and you're losing money on your potential profit that you would have made if you would have just held. So my thoughts on all of this, even though there's a lot of studies out there that say it's better to lump sum invest over the long term because you're going to have more money and more shares, I still think that the average person's emotions are hard to control, and it's not too often that we come across a lump sum of money to invest. Most of us just live paycheck to paycheck, and all we want to do is be able to be a part of the market, and dollar cost averaging helps you do that. Dollar cost averaging also helps you invest into companies that you more than likely wouldn't be able to if it wasn't for dollar cost averaging and fractional shares. Real quick, most apps now do fractional shares. If you don't know what a fractional shares is, literally like it sounds. It's a piece of a share. So if a share costs $100, you have $50 to invest, you can invest into that company and get half a share with your $50. For example, there's companies like, let's say, Cash App and M1 Finance that have reoccurring investments in their apps and fractional shares. So for example, if you want to invest in Amazon or let's say Google, for example, I don't know how much Amazon is. Let's just say $3,000 a share. And I think Google is at about $1,800 a share. That's a lot of money for one single share. So dollar cost averaging literally helps you own shares in your favorite companies because of recurring investments and fractional shares. My final opinion about dollar cost averaging, I believe it's the way to go. It's the best investment strategy because one, it reduces mental fatigue from staring at the market, hoping to get in at the bottom of the market, when we all know that that is almost practically impossible, or you get lucky for doing it. Two, it helps with barrier to enter the market. Again, this has a lot to do with fractional shares. So being able to invest your small amount of money into the market helps when you dollar cost average. And number three, I do it too. I do it with my regular stocks, my ETFs, and my Bitcoin. So I'm always dollar cost averaging. And also, believe it or not, if you work for a company that has some type of retirement plan like a 401k or a TSP, I used to have a TSP for working with the post office. Used to be a mailman. But anyways, these accounts are set up to invest into ETFs. Usually they deduct a certain amount of money. For me, it was 5% of my check was deducted every check and invested into the market. So you're participating in dollar cost averaging, and I bet you didn't even know. But yeah, with that being said, I hope you made it to the end of the video. Don't forget to give me likes, comments, subscribe, and hit the notification bell. And until next time, let's get this money. Peace.